See, risk measurement is basically, in a sense, there are two ways to measure risk. One would be absolute and one would be relative. How we measure risk is for in our own domain is, see, there are two objectives of any investment. That could be the return objective or the risk objective of that. Risk and return objective are both which we see for any investment or trade that we make. The return objective is simple. That is the expected return that we are expecting to make from that investment or a trade, whichever we are taking. And the risk objective can be both to absolute and relative. Okay. So absolute is the risk which is inherent in that asset class itself. And relative is when we try to compare risk with by comparing it with another asset class. Like for example, if I'm trying to go long on a certain stock like DLF and I'm trying to compare the relative risk, I would be either looking at the beta of this or the standard deviation. Okay. So what it tells us is the standard deviation tells us is the movement. Okay. How much it could vary from its actual movement itself. Like let's say if we are expecting a 15% return with a standard deviation of 2 or 3x, which is that much of its median. So that is, so what can happen is that over a certain period of time of which we are measuring, that stock or that asset class in itself can go 2x or 2x up or 2x down from its median return. So if the median return which we are expecting is 15x from the 15%, so we can have a stock like a DLF which can go up 30% or 30% up or 30% down. So that is 2 times over its expected return. So that is how we measure relative risk, by looking at the standard deviation. Of course, there are other tools as well, but standard deviation is one very widely used tool. When we try to see what is the relative risk for a trade which we are taking, that can, one example of that could be comparing the standard deviation of a stock's return, and that tells us that how much could be the variability in returns. Like even if an asset, if like Nifty, it goes, the expected return from Nifty is 20%, and if it is 2 standard deviations, so what can happen is that it can go up 40% also and it can go down 40% also. So we are expecting it to trade at 2 SD of its mean currently. So was that clear to everyone? Okay, great. So anything else? Yes. Relative risk is basically deviating from the underlying index risk as well. Yes. Do we have any other questions? What are avenues for diversification? Sorry, Pat, can you tell me diversification in what sense? Means which context are you asking this for? Means investing. Yes. Okay. So we'll answer Part's question first. We have a question on what are the avenues for diversification. See, diversification during investments comes in basically why it is used to distribute risk. Okay. So what via an example I would try to explain you in this. Let's say if we expect gold to go up in the next couple of years. So what we might do is that we might go long on gold. Okay. The risk that we have from this investment is that if gold goes down. Okay. So if in the next 2 years we were expecting gold to go up, but after 2 years we see that gold is down 50% from today's price, what we might face is we might face a loss. And because we had done only one investment, what happened was that the total investment was wiped off by 50%. One other way of trying to distribute this risk is by investing in other asset classes as well. So any person who would invest the money across asset classes would do what? Would invest a little bit of amount in gold, little amount in equity, and little amount in fixed income. So what might happen is that all these 3 asset classes move differently. Okay. So what happens is that when we combine asset classes which move in different directions, what might happen is that if one asset class goes in our favor, what might happen is that the other might not. But at the end of the tenure, what we might see is that our total average return is sufficient or good enough. Why? Because if we made a loss from a certain investment, we made a gain via another. Okay, and diversification is basically all dependent on asset allocation. So you need to understand what is your asset allocation to know that how much risk are you diversifying. This means only to diversify across asset classes. Like if a person is diversifying across asset classes, what they might do is they might invest a little amount in gold or a little amount in other commodities or equities and bonds. Within stock markets, if someone is diversifying, what they might do is that they might go for different stocks. Okay, so what I might do is that I might have a portfolio which might contain 10 or 15 companies, different companies. So what I've effectively done is that I have diversified my risk across these 15 companies. Now in the next 2 or 3 years or till the time that I am investing, what might happen is that a couple of companies might do very badly, which is an error which we are taking in question. So what can happen is that if 1 or 2 companies do very badly, the total return of my portfolio does not suffer that much. Why? Because we had diversified our investments across a lot of companies as well. Now, how much should I diversify or how much should I not is basically dependent on how are you allocating across asset classes or how are you allocating across companies. That depends on your understanding of the investment which you are making. Okay, so you have to know diversification, you have to understand asset allocation. Asset allocation can take place in 2 measures. Either you can diversify across asset classes or either you can diversify within an asset class, single asset class. Like you might be going for 20 stocks instead of 1. So what might happen is that over a period of time, what can happen is that because you diversified your risk across 15 or 20 stocks, even if 5 or 6 stocks didn't go out very well, your total returns won't be affected that much. Or let's say if you had just 2 stocks in your portfolio and both these stocks performed very badly, your total return would be very bad. So that is why we diversify, and diversification is dependent on asset allocation, and asset allocation depends on your understanding of how the markets might do, how the company, how much you understand the companies. So is that clear, Path? Okay, so yeah. Coming back to other questions, the other question was by Rahul, like how important is fundamental analysis compared to technical when it comes to trading? Rahul, both of these can have equal benefits during trading. How it helps us see, technical analysis helps you to make an entry and exit in any asset class. Or let's say if we are concerned with only equities, how technical analysis helps us is that yes, it helps us in predicting future moves also, but technical analysis helps us greatly in how to enter and exit a stock or when to enter and exit. Means it helps us a lot with the timing of the trade as well. But fundamental analysis gives us a view of how the markets might behave or how the company might behave, but it does not give you very good entry and exit points. Okay, entry and exit points are very well defined by technical analysis because it gives you perfect entry and exit points. So the appropriate thing to do is not to divide between both, like is fundamental good or is technical good via trading. A combination of both works very well. Fundamental helps in creating a view on an asset class or creating a view on a stock. Like you can compare a different fundamental, you can compare the fundamentals of the company with the market itself and generate an idea. Like let's say if I suppose Reliance looks very nice to me based on the fundamentals, like the company's operating performance is improving and etc. Now how to make a trade on this? Technical analysis will help me in this. It helps me in giving an entry and exit point of how to execute that trade. So creating an idea or generating a view can be done by fundamental much better than technical analysis, and entry and exit point of the trade is much better done by technical because fundamentals don't help in getting entry and exit points. So a combination of both works very well. Either of the two are not very good standalone wise. So if you combine both, you can get to very nice conclusions. Was that clear out? Yeah. Okay, great. The next question was by Vishal. How budget deficit impacts the economy and equity market? Okay, see, what is budget deficit? Firstly, every year the government comes up with a budget. Okay, standing. What is that? The budget is basically the revenue expenditure and revenue income which the government expects to generate. So let's say that they expect to spend 100 rupees in this year. For an example, we are taking an hypothetical example that the government is expecting to spend 100 rupees this year. And the government also makes an estimation on how much amount does it expect to earn. Okay, so let's say if the government expects to earn 94 rupees this year and expects to spend 100 rupees. So what is the deficit here? The deficit is 6 rupees, and that is 6%. So that 6% deficit is something which the government has to plug. Because if they want to spend 100 rupees and they can earn only 94, this 6 rupees is the deficit, or 6% is the deficit that they want to plug. How will they plug this? This will be plugged via borrowings. So you have to borrow this 6% additionally from market. Now what happens is, generally, just like we view companies, in a similar manner, if we try to compare countries across itself, like let's say, for an example, a country like India. So what happens is that, let's say if we expect our budget deficit to be very high, or the budget deficit percentage is higher. So what happens is that the additional deficit which is coming, which is the difference between the earnings and the expenditure, this has to be financed via the bond markets, or you have to borrow this amount to finance this expenditure. Now this borrowing creates a pressure. Okay, additional pressure. Why? Because we don't know how the debt markets might behave in the year. And generally what people don't like is countries borrowing too much to spend. We would like the expenditure to be financed by the income itself. And a lot of, if the expenditure is being financed by borrowings a lot, what it makes is that it again brings us to the example of unsustainability. Any deficit, if increasing by a lot, is unsustainable in the long run. So it is okay to finance the deficit for a few years if you are trying to show growth. So what that can do is, like, the higher growth can lead to higher revenues in the future. So what might happen is that a country is trying to show that today I am in a deficit, but 2, 3, 4 years down the line, when the income starts improving, this deficit will be curbed. But what if that does not happen? What if the revenue does not improve? Then the deficit worsens further. And further deficit worsening means poorer macroeconomics. And poorer macroeconomics are poor for a country. So any country, if the budget deficit is improving, that is generally considered very good. A lot of foreign investors would want to invest into this country. Why? Because they know that there are no external borrowing pressures. Again, if the budget deficit is expected to go higher, what happens is that it creates an additional borrowing risk. So any investor in the foreign market, if they would be skeptical in investing into these countries. Why? Because any additional borrowing pressure can create additional risk, like for an example, Greece is facing right now. So obviously the budget deficit impacts the market, and this is the way it impacts. So was it clear, Vishal? Yes, see, basically what happens is that this deficit can be filled by various measures. Either you can borrow, or you can get foreign remittances, or you can get foreign FI investments. All of these three measures can be used to curb. What happens is, basically the government would want to depend on borrowings as a matter, but any sustained increase in deficit, okay, it can be financed for a few years on the assumption that revenue might increase in the coming years to plug this. So it does not create a very short-term problem. But what happens is that if this deficit increases, keeps on increasing, how much investment can come from the foreign countries also? Why? Because let's say you don't know when there might be a recession in Europe. So if most of the funding comes in India from Europe, and you are expecting to plug that deficit via European funding, what if there is a recession in Europe? Then what can happen is that then the deficit can be a pressure on you. Why? Because till now you were relying on the European countries to put in investment into your economy to plug the deficit. But what can happen is that external amount of money, you don't know that when it might go off, or when there might be a problem in any external country. So relying too much on external investment to plug your deficit is a problem. Obviously, it is not a problem in the short term. You can obviously finance it for a couple of years or more than that. But generally, relying on other countries investing into your markets to plug those deficits is not considered a stable scenario or a sustainable. So what you are seeing is that India is trying to curb its fiscal deficit for the last 2-3 years, and you are seeing increased foreign investment because countries also like to invest in other countries where deficits is going lower, because they know that the macroeconomic condition is very stable. Okay, so you won't be relying on external borrowings. Was that clear, Vishal? Yeah. Okay. We have another question from I said Pawan. Analysis is fine, but fractional major influence the index. How shall we protect our capital? Please ignore if the question is irrelevant in this session. Okay. See, protection of capital is something different. What happens is that there are two things to do. Either you can either you can preserve your capital or you can grow your capital. Okay. Preservation of capital is basically done via fixed income investments, not via equity investments. Equity investment is basically used to grow your capital. It is used to grow your wealth and not to preserve your wealth. Fixed income, what it does is that it gives you a fixed rate of return, which is generally in or around inflation or a little less than inflation also. So what it does is that in the long run, if let's say I am putting X amount in an FD right now for the next 5 years, what it might do is that it might give me a return in or around inflation as well. So I might not generate very high rate of returns, but what I might do is that I might preserve my capital. Equity is not used as a measure to protect your capital. Equity is used as a measure to grow your capital. So you would always have that risk of losing your capital if you make wrong investments or if there might be anything wrong going on into the market. But then again, what happens is that if you are properly educated in a financial sense, like if you have proper financial education, you would know how to create a balance between growing your capital and preserving your capital. Because if we preserve all our capital, what might happen is that in the next 10 or 20 years, you will not win against inflation. So your net return would be negative in the next 10 years if you try to preserve 100% of your capital. But yes, if you know the methods of how to grow your capital as well as protect it simultaneously, what can happen is that you can create a very nice combination wherein you can also grow your capital and also know how do you need to protect a bit of it. So there is a combination of both which you can use and which is very widely used also. Because in net effect, if we try to preserve all our capital, we are actually getting negative returns over a longer period of time. So it is not advisable for me to tell you to only preserve your capital. Yes, you can preserve your capital also via equity investment, but you need to know the proper methods how to do that. That is done via fundamental analysis. Okay. So am I clear, Pawan? Yes, see, basically, your understanding of this will be obviously improved by the course only. That is what I was trying to explain, that financial education helps you in this, that how to preserve your capital and how to grow it simultaneously. So obviously, yes, at the end of the course, and then it also depends a little bit on you also, that how much were you able to grasp at the end of it. Okay. So but basically, better understanding of company fundamentals and country fundamentals helps you a lot in knowing how to preserve and grow your capital simultaneously. That is what the course is for. So I suppose that would be fulfilled by this. Was that okay? Okay, so see, this is what the reason. See, I suppose you might not be having a very high grasp of fundamentals right now. So if you think, even though at the end of the course you might not have been able to generate that much amount of knowledge which you wanted to regarding to your questions, you can always come back to the course coordinator in understanding that whether you need an understanding of something else also to do it. Obviously, financial education helps you in a sense, and a deeper understanding of fundamentals helps you a lot in preserving your capital also. So you might have faced some risks which you did not know about. So a proper understanding of all the risks involved, a proper understanding of the fundamentals, I suppose would actually help you a lot in reducing your risk and preserving your capital. Okay, so I suppose this can be done either at the end of the course or either after also the course. You can talk with the coordinator regarding if you were able to eliminate all your queries, or you would need further understanding of fundamentals as well to do this. Okay. Yeah, sure. Okay, thank you. So the other question was by Shishir. Why is the currency devaluation by China in the last few days affecting the rupee as well as the Indian stock market? And the RBI looking at devaluation of rupee to counter China? See, yes, Shishir. Before this, you need to understand the forex scenario of both these countries. Okay, today India is in no condition to do anything if China is trying to manage its foreign exchange. Okay, China has, before understanding this, I would like to tell you that China, the amount of foreign reserves, any central bank or any country, they can play with their currency valuations based on how much forex reserves they have. Okay, India has around about 300x something $1 billion of reserves. China has more than 3.5 trillion of reserves. So China has basically 12 to 13x the amount of reserves India has. Okay, so they are that much more competent in trying to play with their currency is the actual term with that. Now, is RBI looking at devaluation of rupee to counter China? See, what will happen is that there is an automatic devaluation of the rupee when that is happening. Okay, so there is an automatic devaluation which happened, which led to a 2% decline. So that was okay, which the market itself did. But going by your second question, is the RBI looking at devaluation? I will try to tell you that RBI does not have the same powers that China has with regards to its currency because of the impressive forex reserves which China has. So anything which China does impact the economy, will also impact us. And bear in mind this also, that India is not competent enough to do the same things which China does. So if they enter into a fight with us with regard to their currency devaluation, we are not very well competent enough to counter them. Okay, but there is a natural devaluation in the rupee as well. So that was countered the devaluation in the yuan itself. But going by the second question, I don't think India has the advantage of trying to counter China. And that obviously will affect the markets as well. See, sudden fall in stock might increase in gold prices. You need to understand, see, stocks and gold prices, what they are. Gold is an actual hedge against risk in the market. Okay. So what happens is that whenever there is any risk in the market, what happens is that people rush to buy gold. Why? Because now you are seeing, see, there are 2 or 3 asset classes in the world wherein you people would invest. One asset class is equities. Okay. If we try to see over the last 1 year, equity markets have not given a very high return, and they are not expected to give the same also. Okay. So over the last 1 year, people have been disappointed by investing in equity. One. Secondly, commodities are going down. So there are no other asset classes left. So what happens is that whenever there is a risk, like what China did was something out of the box. So whenever there is something which happens out of the box, let's say there is a political risk or a geopolitical risk, like let's say there is a tsunami somewhere, or there is something which happens out of the box by any economy like Japan or China or US. What will happen is that there will be a general rushing of people to buy an asset which they consider very less risky, and which is gold. Okay. So whenever there is a risk in the global markets, you see a rise in the price of gold. And obviously equity markets are risk inducing. So there is a lot much more risk in stock markets than the gold prices. That is why you see stock markets fall during these times. Uncertainty generally brings with itself a fall. Okay. So the main idea is that because there is so much uncertainty in markets, that is why you are seeing a rise in price of gold and fall in price of equities. And uncertainty always brings this. So right now there is global uncertainty. When US might increase interest rates, why is China devaluing, Greece is going into fresh elections, India not improving its results. So because there is uncertainty, there is an increase in price of gold. Till this uncertainty passes off, let's say it takes 2 months, 3 months or 6 months, till that time you will not see a fall in gold prices or a rise in equity markets. If this uncertainty goes off in 1 month itself, then you might see a rising stock markets after 1 month. Was that clear to you? Yeah, sure. Okay, no. So another question by Vishal was that what factors are considered to come to a conclusion to a fundamental answer of a country's macroeconomic status? See, 2 or 3 simple examples you can use. One very basic thing is what is the interest rate of that country. Okay. So interest rate of that country means what is the country paying on the borrowings. Okay. So for an example, to understand majorly how is India trying to do, you will see the borrowing cost of the government. Okay. The borrowing cost of the government effectively will include all macroeconomic factors in itself. There are a lot of macroeconomic factors like the IIP, the inflation, the GDP data, other macroeconomics, unemployment status, what is the inflation scenario. But all of these, what they do is that either you can look at all these individual factors, or either you can look at the bond rates of the country. Okay, so the sovereign bond rates, which they are, the sovereign bond rates, what they do is that they will move based on all these macroeconomic factors. So if you are following the sovereign bond rate of any country, you are actually following all the macroeconomic data. So if a country is doing very well on the macroeconomic front, the sovereign bond rates, which is the borrowing rates, will be falling down. So what you see is like a Germany or a US has very low borrowing rates. Why? Because their fundamentals are very sound. India has a higher borrowing rate. Why? Because the fundamentals are not so sound as a US or a Germany. So you can try to follow all these factors like the inflation, the GDP, the IIP, or you can simply track the bond prices of the government. Okay, and which is the 10-year yield. So you can either see the 10-year yield or the 5-year yield, but the 10-year is basically enough to know that. So was that clear, Vishal? So Vishal, was that answer clear to you? See, sovereign rate is basically easy. You can just go online and check the bond rates of the country. It's easy in itself. To check bond rates of other countries, okay, you need to go to any website. So you can use, for India 10-year, you might just go to India 10-year G-Sec rates. So see. This is the current 10-year bond yield. So currently India is paying 7.78% on its 10-year bond. You can see a chart of this. So this is a website wherein I suppose you can get all the 10-year bond yields of other countries also. So this is this is an area where you can get the 10-year. See, US 10-year borrowing rate is 2.045%. US 30-year is 2.73. Euro is this is a euro bond price, not the yield. This is also the gilt prices. So these are areas where you can get yields and prices of foreign countries, and this is where you will get the Indian bond prices. So was that okay? And you can see the website in which I'm using to check these rates. So is that okay, Vishal? Yeah, okay, thank you. So the second question was from Saurabh. As a secondary market is between investor, not directly the company or the stock price. See, how does the stock price itself help? The stocks are of a company, and the company is owned by the promoter. Okay, so it is majorly held by the promoter. So any increase in the stock price directly increases the wealth of the promoter itself. So let's say for a company like Coal India, the major promoter is government, which holds an 80% stake, and the valuation of the company right now is 3 lakh crores. Okay, so if in the next 5 years, if the company valuations go from 3 lakh crores to 10 lakh crores, and if 80% of this is being held by the government, this actually directly increases the wealth of the promoter itself. So this is how the stock price increase. It does not help or unhelp in any way. It just increases or decreases the wealth of the major promoters and the other stock owners who hold the stock itself. So you might see a same increase in wealth for yourself, which is the promoter is witnessing. So any companies which have grown over the last 20 years, their promoters have also increased their wealth over the last 10 or 20 years of whatever that has happened, and that is how it helps the companies itself. Okay. So what they can do is that they can sell their equity at higher prices. Their wealth might increase. Someday they might offer to liquidate their business, so they might get a higher price itself for that. So was that clear, Saurabh? Yeah, okay, thanks. Next question was from updated things happening on the globe during trading hours. See, if you want to check out the global news. There are two websites which you can check. One is these are related to global markets only, not Indian markets. One is Forex Live. So you can get technical analysis and trading tools for all the global markets on this website, and this is live during trading hours. So this is absolutely live, and you will get a lot of information there. Okay, so this is basically the weekend Friday news, whatever that was happening. Another website for this could be Forex Factory. So this also provides you a lot of information regarding trading and also other things as well. So news, you can have all latest news. You can have forums on different, so a Euro USD forum. You can have different trading, whatever is the new, whatever is the trading calendar. So whatever is the news or whatever is the data which is expected to come. So two of these websites, Forex Factory and Forex Live, are very helpful to know the updated things around the globe and whatever is happening in the world market. So this gives you a very live view of what is happening in the globe. So is that okay, Pawan? Yeah, okay, great. Welcome. Again, another Shishir asked us about the effect of 10% stakes in an IOCL and the stock prices. Again, we abstain from trying to predict stock prices, but whatever is the logical explanation of this is, see, obviously the OFS price will be lower than the market price, and also as a retail investor, you will get a 5% discount to that. You might see a fall in price on Monday. Okay, but going by the fundamentals, IOC is expected to do very good over this period of time. So even if you see a falling stock price in IOCL, the expected thing to do is the stock might behave in a negative fashion on Monday. But if the crude prices remain lower, I expect IOC to do good after this only, because this affects the company in no fundamental way. What is just happening is, see, the logical effect of this is what the promoter is, which is the government, is selling 10% stake to other investors. Obviously, they will sell it at a discount, and if you are getting it at a 5% discount, you are basically getting it at a lower price than the market. Now, if IOC is expected to go in the next 1 year, which it is because of crude prices being lower, then what will happen is that it would be advisable for you to buy IOC at these prices, because you are getting it at discount. Okay, so that is how the stock prices would be affected. So was that okay, Shishir? Yeah, okay, great. Next question was from Parth. See, primary and secondary market are obviously complementary. Secondary market is the market which is functioning every day in front of you. Primary markets are dependent on the secondary markets. Why? Because if the secondary markets are not performing good, the primary markets also don't perform very nicely, because people would not want to come out with issues. Because if there is no appetite in the market to absorb these issues, means if there is no fund, no money out there, then there is no point in coming out with IPOs. Why? Because the IPOs might not be subscribed, or you might not be able to get valuations which you want. Okay, so that is one thing. This is how the primary and secondary market, why they are complementary to each other. Good secondary markets does what? Good secondary markets are only happening when there is a lot of liquidity in the market and there is a lot of demand for companies. So when there is demand for companies, companies also come out with IPOs. Why? Because they expect their IPOs to do well. They expect higher valuations. They expect the stock market to perform nicely. So they expect higher valuations for their companies itself. So that is why we see complementary markets for both. So was it okay, Parth? Yeah, so great. Next question was from Pawan. Money control is basically you want to know about how the website is or not. Indian market, I don't think there is any other website which gives you more comprehensive idea other than money control. So you will get all India related news and everything else. If you are very much concerned with the Indian markets, money control is okay, because they contain most of the news which is happening. Apart from this, you can also check the websites of the basic newspaper companies also. So a businessstandard.com or an ET, economictimes.com, also gives you equal help with that regard. Domestic market related information, money control, ET, business standard, business line or live mint, these are proper tools for you. So is it okay, Pawan? Yeah, great. Vishal has asked which site would recommend for technical analysis. Technical analysis, investing.com is a very nice tool. slightly delayed, but as a website or a tool, you can use Metastock, which is a paid tool for technical analysis. Obviously, I'm not very proficient in technical analysis, but the both of these, investing.com is a free tool. They can give you a chart of any company also. So if I want to check the chart of Reliance Industries, I can go and check the chart on this website also. So you get proper charts also with all the tools itself. Otherwise, if you want a very comprehensive tool, you can go for a Metastock. Okay, so or a Metastock or a Falcon, both are paid softwares, but you will get much more data and much better, I suppose. So if you are planning to trade professionally, go for a paid software. If you are not planning to trade professionally, just for an educative purpose, investing.com is okay. But if you are planning to trade professionally and you plan to make a career out of it, I suppose you should use either a Falcon or a Metastock for technical trading. Is it okay, Vishal? Yeah, great. Okay. Any other questions? Yeah, okay. See, repo rate declarations from RBI does affect. We see what is repo rate first. We see repo rates is basically the rate at which banks borrow from RBI. Okay. So whatever is the repo rate, how does it affect? Because banks do most of their funding from the RBI. They borrow a lot of money overnight, intermediary. So what happens is that there is a cost on that. Okay. So there is a cost of that fund which RBI gives to banks. And what it helps is that if the cost of what happens is that if the cost for banks decrease, the cost for you decrease. Okay, so banks, the basic cost of funding is dependent on what is the repo rate and what is the CRR. Okay, so what is the reserve ratio? CRR is basically the amount of reserves that the banks have to keep with regard to their assets which they have with the bank, with the RBI, and they don't earn any return on that. So the CRR and the repo rate affects how? Because it moves the cost of funds for bank. And if the cost of funds for bank increase or decrease, they affect the economy as a whole. Like if the repo rate decreases, what happens is that simultaneously there is a decrease in cost of funds for banks, and hence they decrease the lending rates also. So if the lending rates are decreased, there is slightly higher demand from the economy also for houses, for personal goods, etc. So any change, increase or decrease in RBI's repo rate increases or decreases the cost of fund and simultaneously affects the market itself. Like it increases the borrowing cost for us if the repo rate increases, and it decreases the borrowing cost for us. So for an example, if the bank funding is very low, then what might happen is that people might buy more cars, they might buy more houses, and the economy performs very nicely. So what happens is that there is a increase in performance. Simultaneously, if there is a increase in rates from RBI, so what happens is that there is an increase in cost of funds. So we might buy lesser cars, we might buy lesser houses, and hence the GDP is also affected, because how much spending people do, that also affects the GDP as well, and that is why it affects the markets. Generally, markets likes decreasing cost of funds. So if the repo rate decreases, markets very much like that, and we discount that factor also. So I was saying to you in the start that if interest rates are expected to decrease, markets do good. Why? Because the demand at the bottom end of the market increases. Okay. So this is how it affects the markets, Pawan. So was that okay? Fixed relation in the sense, it's not completely fixed. It might change, but this is the general understanding from this. Like how does the repo rate increase or decrease will change? This is the standard understanding of this topic. So other question from Vishal, next question from Vishal was about fiscal and monetary policies differences. You see, fiscal policies are the basic differences. Fiscal policies are government controlled and monetary policies are controlled by the central bank. So that is one major difference. Any change in fiscal policy will be affected by the government. Example for that would be government spending. Okay, so if the government plans to spend more, that is an example of a fiscal change in the policy. Monetary policies are affected by the central bank. So both the institutions, there is a difference in the institution which manages both these things. A different institution manages the monetary policy, which is the central bank, and for us it is the RBI, Reserve Bank of India. The fiscal policies are maintained by the government. Okay, so the government affects any fiscal changes which happens. So that could be an example of a monetary policy change could be the repo rates. See, so that is an example of a monetary policy shift that is done by the RBI. The institution managing this is different. Secondary, any fiscal change might be increase or decrease in government spending. Okay, based on whatever is the outlook for money coming in, and the institution for that is different. So that is the government. Fiscal and monetary policies are both tools to manage inflation and growth. Both are used to either increase growth or decrease inflation. Example could be to increase, if you want to decrease inflation, you might go for higher repo rates. So the borrowing cost would increase. That is done to do what? That is done to decrease the rate of growth at which the economy is growing. Yes. Fiscal spending, see, fiscal spending is increasing. What it implies is that the government is spending more. Okay. And that government spending, what it will do is that if the government spends more, there will be more growth. And if there will be more growth, inflation is expected to move higher in the coming years. So that is how fiscal spending affects the market. If the fiscal spending is lower, means the government is spending less. And if the government is spending less, there will be what? There will be lesser demand for goods. Okay, so the growth is expected to slow down. So that is how fiscal things. In fact, monetary policy is a tool to manage inflation. So what RBI does is that it uses monetary policy in tandem with what the fiscal policy is currently, so that it can manage inflation accordingly. So was that clear? Vishal, was that okay? Yes. Perfectly. See, changes in monetary policy will impact the fiscal policy of the government also. But what generally happens is that the RBI and government will work in tandem. Like if the fiscal spending is expected to increase, the RBI will not decrease rates. Why? Because they already know that the growth is being supported by government spending. So interest rates might not be decreased further. And if the government spending is not increasing a lot, what RBI will do is that they will know that the growth in the next few years will not increase that rapidly. So there will not be very high inflation. So they might go and reduce it. So both will work in tandem, and both will have to see that whatever combination is working. If the fiscal spending is expected to go up, RBI will not decrease interest rates. Why? Because government is supporting growth. If the fiscal spending is expected to come down, what will happen is that the RBI would know that inflation would not be a problem in the near future, and they might decrease interest rates. Both effects and both are used simultaneously and in tandem with each other. So was it okay? Yeah, great. Welcome. Anything else? we have a question from Vishal, like how the RBI policies impact the state-run banks and private banks differently. See, policies, any policy by the RBI per se does not differentiate between a public sector bank and a private sector bank. Basically, the only difference is that the ownership of these both are different. A public sector bank is run by the government, and a private sector is bank is run by private professionals, okay, and private companies in itself. No RBI policy will impact a state-run bank differently or a private bank differently. What it can only do is that there might be changes. There might not be any changes from the RBI side which will affect both either of these two institutions differently, because RBI is only concerned with how banks totally function. RBI central bank is a institution which manages banks. It does not manage banks differently. Okay, so any different thing which has to come, like any policy which might affect a state-run bank differently and a private bank differently, has to come from the government. There is no policy as such from the RBI which will affect a state-run bank differently, because if RBI only manages banks, they do not differentiate between a private sector bank and a public sector bank. Whatever tools they have affects both these banks equally. Obviously, any tool which has to affect a private sector or a public sector bank differently has to be done by the government and not by the RBI in itself. And government is the owner of the state-run bank, so any policy change by the government is the only thing which can impact a state-run bank differently from a private sector bank. So that is the only issue out here. So is it okay? What you are trying to ask from me is that just RBI policies will not affect. What happens is both the promoters of an ICICI or an Axis Bank is different from a State Bank of India and a PNB. Try to understand one thing which is at the root of this cause is any state-run institution is owned by the government, and the function of the government is generally to serve the nation. Okay, and not per se profit-making entities. Or yes, obviously all the institutions are profit-making entities, but generally per se the government, the first idea of them is public, because they are public sector institutions. Their idea is to serve the public and not generate huge profits in itself. When you compare it with an ICICI or an Axis Bank, they are complete professionally run institutions. Their sole objective is profit-making. Their sole objective is also serving the banking public in itself, but their objective from that is to make a profit. State Bank of India also operates on the same mechanism, but what the only difference which is there is, because these are state-run entities, what happens is that they generally do a lot of work which private banks will never do. Why? Because profit is not the sole motive of a government. So what you will see is that whenever there is an agri loan waiver, or if there is a agricultural distress in a certain state like in Andhra Pradesh or in Maharashtra, the government might instruct the public sector banks to forego the loans, and they have to take a hit on their profits. Why? Because the government has asked them to do so. And why do they have to do so? Because government owns these banks and they have to work according to the government, and the government can do anything and does not have profit as the sole objective for them. This is the main fundamental difference between a private and a public sector bank. A private bank cannot be instructed by the government to do an agri loan waiver. So there is no government intervention in these private banks, and that is why you see the stocks of private and public sector banks behaving very differently. Is it okay, Vishal? Yeah, sure. Okay, great. Anything else? Yes, component would be, see, Vishal, would be the component which has a higher weightage in that index. Okay, so whichever whichever component or company has a higher weightage, that should be looked at, because they are the people, they are the companies which will be moving the index. So for an example, if HDFC Bank has a higher weightage in the bank nifty, you need to look at HDFC Bank, okay, or whichever are the top 3 or 4 companies which have the higher weightage in bank nifty, that is what you should be looking at, and not all other banks randomly. So was that okay, Vishal? Sorry, driving factors. Okay, so you want the, see, bank nifty driving factors is basically anything which affects banking. Okay, per se, the first idea would be repo rates. Okay, so the trend in repo rates in the future, try to understand this. The current repo rates don't per se have any moving on the index. The expected trend in repo rates or interest rates by the government will have a lot of moving effect on the bank nifty. So if the RBI is expected to decrease interest rates further in the near future, then that will be the sole moving objective of the bank nifty or banking stocks as well. Why? Because they are affect the banking stocks mostly. That is one fundamental factor which affects all banks, not just one single bank, and it is same for private sector banks and PSU banks as well. Secondly, now when you come down to different companies, like let's say if we are discussing State Bank of India, any public sector bank change, if you want to see, you need to understand what the government is trying to do, okay, to understand how they might change. So if the government is expected to come out with policies which will help the PSU banks, then PSU banks might perform good in the coming future. Why? Because this is something which is affecting the individual companies itself, okay. It has got nothing to do with private or public. It has got nothing to do with private sector banks, but public sector banks, because the government is bringing out some different policy which is expected to affect the public sector banks only. That is why these public sector banks might do good or bad based on these things. Similarly, let's say if there is some company specific factor happening with Axis Bank wherein it has improved its operating performance, so that might individually impact the stock of Axis Bank. So macroeconomic or at a macro level, any changes happening by RBI affects all banks, which are the most important for you to see. So inflation, IIP, GDP data, these affects banks on a macro level, all banks, private and PSU alike. And secondly, coming down from there, when you are selecting individual companies specific factors will affect. So a factor which affects only ICICI Bank or an Axis Bank will be changing the stock price of that company, and any other factor, if it is affecting State Bank of India or any other public sector bank, that will be driving the stock prices of the PSU banks. So is it okay? Yeah. Okay, great. We had a question by Parth as to how to calculate a company's operating cash flow. Parth, you don't have to calculate the operating cash flow for a company, so it is given in the annual reports itself. So let's say if I want to check the operating cash flow for any company, for let's say Dabur. So what I can do is simply go to, either I can go to the website of the annual report, or what you can do is like you can use a website, you can use this screener. This is a website which gives you a lot of information on that. So I can basically type any company's name, let's say Dabur India, and I can check what is the operating cash flow right here in the bottom. Okay, so cash from operating activities. This is cash from operating activity, which is the operating cash flow. So you can see 2006, 7, 8, 9, 10, 11, 12, 13, 14, 15. This is the operating cash flow of the company. Okay. So this is how you can get it. You don't need to calculate it. It is calculated and given to you on websites also, and also on the other indexes, also on the annual report of the company itself. Okay. So is it okay? Yeah, great part. Any other questions? What is capital asset pricing model? CAPM is basically nothing but it is just a tool to calculate the cost of equity for a company. CAPM basically, CAPM as it is pronounced as CAPM. It basically tells you how to calculate the cost of equity for a company or the total weighted average cost of capital for the whole company itself. It has two tools, one which is the cost of equity. The cost of equity for a company is calculated as the market rate of return, means the formula is RM in beta plus beta into RM minus RF. So what it effectively does is the cost of equity is calculated as the formula is basically nothing but the market rate of return plus the beta and the equity risk premium. Okay, so what it is, a cost of equity is a factor of all these three things. What it actually does is the equity risk premium is multiplied by the beta. What is the equity risk premium? The equity risk premium is basically the premium which you pay to generate a above average rate of return or above average risk-free rate of return. So if the risk-free rate of return, let's say right now is 8% because of the government 10-year bond rate, which is the risk-free rate. So 8%, and if the market is expected to give 20% return, so the risk premium is 12%. 12% multiplied by the beta, okay, plus the market rate of return is the cost of equity which you give as well. This is the cost of equity, and the weighted average cost of capital is nothing but KE, cost of equity, into the weight multiplied by its weightage plus the cost of debt multiplied by its weightage. So that is basically, that will basically give you the cost of the weighted average cost of capital for a company. So this is the actual CAPM or the capital asset pricing model for you. Nothing too difficult to understand, just to learn the formula and have a little bit of understanding as to why it is used. Okay. Okay, Parth. So do we have any other questions? We have 10 more minutes, so we will end at 1 o'clock. So are there any other questions? Example of a personal trading experience I would like to share with you all. Recently I was long on Indian rupee over the last 3-4 months. The reason being, it was purely fundamental, based on whatever macroeconomic. If you try to see the macroeconomic factors which are currently going on right now, you have crude at almost its last 40 years low level. So what happens is that India basically imports only two commodities majorly, which is crude and gold, and both of these commodities are at almost their historical low prices. Okay, so what is happening is that our import bill is going down by a lot, and that has brought down our current account deficit. Okay, so on the current account deficit front, India might actually turn out to a surplus. Okay, so we might go from a current account deficit economy to a current account surplus economy, one. Number two being the fiscal deficit scenario, which is the difference between the government spending and the government income. Fiscal deficit is also reducing, and the reduced cost of crude oil imports is helping our government also. So the fiscal deficit, which was increasing rapidly over the last 3-4 years, has toned down. Another macroeconomic factor is the forex reserves. So India has decreased its forex reserves massively over the last 12 months, credit to Raghuram Rajan, who has been buying dollars from the market. So all the macroeconomic factors, if I try to see with regards to India, are supporting the Indian rupee. So even in the last 1 year, what we have seen is that we have had very poor, also very difficult currency markets. Like all the other Asian currencies or all the other global currencies have depreciated rapidly against the dollar. And if I compare the Indian rupee to it, Indian rupee has not weakened that strongly against the dollar. So it has been relatively much safer apart from this currency devaluation which happened by China a couple of days ago. Okay, so you have seen very stronger rupee levels. I was long on the rupee before this devaluation by China happened. Again, entry and exit are to be used. Entry and exit can be used done by only technicals. So I used technicals for entry and exit into this trade. It was running for 3 months. So I was long on rupee for almost 3 months, and it was a money making trade, which I squared it off when China made that devaluation move. So that is one example of a very recent trade which I did. Yeah, okay, great, sir. Are there any more questions? Vishal, I suppose Kiran has left the meeting, so you can mail her if you want a documentation for this module. Okay, so you can try to contact her on the cell phone or you can mail her. So she might be able to give you a correct answer for that. Okay, great. I don't think there are any more questions. So can we end the session or are there any more questions with us? Okay, so we will end the session and we'll join in whenever we have our next session. Okay. So I'm ending the meeting for everyone. Is that okay? Yeah, it's okay. No, it's no problem. Okay, great. Thank you all. And just ending the meeting. Yeah, sure. Bye.